Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the podcast, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington, anything that affects our local markets, real estate markets, that is. And we will, take the perspective nationally, because obviously there's many people that are listening throughout the United States and in many international countries at this point as well. But, we want to kind of break things down and kind of give you a bird's eye view of what we think is actually taking place. A lot of the national news is obviously, it kind of gives you an overview of what's taking place, but most of the time it's slanted in the direction that Wall Street and everybody else wants you to believe. And we want to really tell you the nitty-gritty about where we think things are headed as far as real estate, interest rates, whether credit's tightening or loosening, and just, the overall situation to help you make more informed buying decisions, selling decisions. If you're looking to obtain mortgages, we can kind of give you the scoop on where things are going. Joining me on our panel, as he does each and every week, is Louis Camerasato. He's a former school teacher, a former attorney, and a former general manager of a major real estate portal. Been cited in the media as a real estate industry expert in the Inman News, Wall Street Journal, Forbes, Fox Business, U.S. News, and numerous others. Louis, how you doing today?
I'm doing splendid, Ryan. How are you?
I'm doing well. Hope you enjoyed your 4th of July weekend.
It was great.
Obviously, we didn't get to do a podcast at the end of last week because we did have the holidays, so we're catching up this week. So just to kind of recap a little bit about what took place as far as things on the economic calendar from last week, we did have the non-farm payrolls that were for June for 288,000 versus the estimated 212,000. In May was revised from 217 to 224. And the unemployment rate was 6.1 versus the estimates of 6.3. So here we go again, Louis. Looks like everything they're trying to, heading into this summer as we move along, they're trying to, it looks like these reports have them somewhat skewed to where everything is starting to turn the corner again, which is pretty much what we thought, right? It's like they're gonna try to find a way to make things a little bit more rosy as we move along here. I'm not putting much stock into these numbers, as we always mention, because there's so many things that they don't really take into consideration. And you and I both know that the real unemployment rate is nowhere near 6.1%. So I want to kind of get your take as we're moving along here into the summer as to what you think is going to take place. I know a lot of the traders on Wall Street are now predicting that the Fed at some point is going to move the key rate, the Fed funds rate, up by, 0.25% by September of 2015. Now, that had moved, I believe, from at one point it was only like a 56%. Now it's, up to a 72%. So this really means that, Wall Street is saying, okay, well, looks like things are really starting to turn a corner. But in reality, the Fed has to know that things aren't really getting that much better. And if they start raising those rates too quickly, it's going to put a major drag on the economy. And not to say that we don't already have a drag on the economy, but I think that would have some implications that some people are not prepared for. Want to get your take on, obviously, these skewed employment numbers, what it really means, and where you think we're headed through this summer. It looks like they're trying to give a little bit of hope, but really, what do you think is taking place?
Okay. Well, let's go back to 2009. You mentioned the anticipation of when the Fed might raise rates. You're talking now mid-2015. If you go back to 2009, when Bernanke started this money printing experiment, he talked about, well, when the economy starts to recover, that'll be the time when we can pull back on the QE and start to raise rates. 6 years later is basically what we're talking about now, Ryan. So it's kind of ridiculous that they keep pushing that time out. There can be no recovery if it takes 6 years and they keep insisting there's a recovery, but they still have to keep interest rates low, but they still had to print $4 trillion and are continuing. They may have tapered, but on record, they are still putting money into the economy. Now, as to the jobs report, Ryan, it was kind of I thought it was kind of disgraceful what I saw in the media. If you look at what the Fed's been saying, the Fed has been playing the whole normal card. Everything is getting back to normal. You had Fed President Williams from San Francisco talking about as things get better, we can kind of get back to normal. You had Bullard talking about we're ahead of schedule and that things are getting better, where things are becoming normal. You had Yellen talking about there is no bubble and we're not going to burst the bubble. We can't use monetary policy to deflate bubbles. Of course, they can use monetary policy to inflate them, but of course, there's nothing they're going to do there because it's all part of we're getting back to normal. Those valuations in the stock market, as far as they see, that's what they want, so they call that normal. Fed President Dudley, same thing. We'll get a rate hike in mid-2015. We're getting unemployment lower. Again, everything is back to normal. But now you go over to the media, and this is where you and I predicted they refuse to see the first quarter as anything other than some type of aberration of why we had negative interest rates because it was the weather. Well, now they got this jobs number, and you've got a tale of two interpretations between the mainstream media, and we'll include CNBC, Reuters, Associated Press, which I call Associated Propaganda, Fortune, all those mainstream media type organizations who, when this job number came out, went absolutely bonkers about, here for example, Fortune has a headline, "Happy Birthday America, you got a killer job report." Then you go down to the New York Times, who talked about how many segments of the economy are rebounding. Now these broader economic gains are prompting business to actually hire significantly more workers in response to growing demand. Bloomberg talked about job growth blowing past expectations and the unemployment rate falling to the lowest level since before the financial crisis, now creating a firm foundation for stronger U.S. economic expansion. Associated Press went even further. Not only did they tout the job numbers, they then put a feature story out called "How Does the U.S. Economy Do It? What's making the U.S. economy a world beater? 5 factors." And they talked about how, well, the economy shrunk 2.9%, largely because of a brutal winter, but now the U.S. economy is expected to grow a healthy 3%. And then they give 5 reasons why the United States is such an engine for growth and for the whole world to emulate. And I won't go into the 5 of them. We'll publish it on the blog post. But the first one they list is the aggressive central bank. So basically, here they are touting Federal Reserve coming to the rescue and creating this wonderful circumstance where we have this great growth. Now, that's the mainstream media's point of view. If you look at the alternative media, well, they dig behind the numbers, and they say, well, wait a minute. There were 800,000 jobs created, or a net 280-some-odd thousand, but of those, it was 800,000 part-time jobs. And we lost 523,000 full-time jobs. Well, if anyone is scratching their head and looking at it, they'd say, that's not that good. In fact, that's pretty bad. That actually shows that we're moving towards a part-time economy, that people want to work full-time, they can't work full-time, and that employers are hiring people part-time because of Obamacare. They don't want to pay the extra amount. So Zero Hedge points that out right away. David Stockman points the same thing out, that full-time jobs declined by 523,000, but part-time jobs surged 840,000. He mentioned also that the professional and business sector is moving up, and that's all about cutting costs. And then he mentioned the other part of the economy that grew was education and healthcare. Well, those are all government-sponsored areas where, of course, you can have a lot of, just push jobs that they can push into to bloat the expenses because they're all being paid for, by the government. Right. Dr. Paul Cray Roberts made the same point that, well, hold on a minute. You got the unemployment rate down, but this is something you and I talk about every week. I mean, that's because there's fewer people in the labor force. They don't count discouraged workers, and basically we're down at a 37-year low on labor force participation. So fewer people are working. 92 million people are not working. Now, Ryan, I had a little back and forth with a Fortune reporter who wrote the Happy Birthday America, You Get a Killer Job report. And I wrote to him and I said, basically, what are you kidding me? You had 840,000 part-time jobs and you lost 523,000 full-time jobs. And he basically said, well, that's he basically said, you're grasping at straws. This is a great jobs report. And I said, no, you lost 500,000 full-time jobs. The labor participation rate is down to a 36-year low. 92 million people are not working. That's not grasping at straws. That's real data. His response to the part-time workers, I said, look, it's not a glass half empty, half full issue about the jobs report. It's an issue of whether it's a glass or it's just made out of paper. And he said that the people working part-time, well, that's supposedly all voluntary. So people, they want to work part-time. So this is a good thing because 800,000 people managed to find it. And he doesn't see a problem that structurally we're losing full-time jobs and we're increasing part-time jobs, and that's all voluntary. So therefore, don't worry about it. People want to work part-time. If that's what they want to do, the economy has delivered that to them. And then you take that in with the New York Times and the Reuters and the AP story, and you realize these guys will say anything to promote the concept that somehow we have turned the corner, that this job report was such evidence. There was another guy, I think his name is Walters. He's a Keynesian economist out of Michigan. He put out a blog tweet. He said, a tweet on Twitter, I defy anybody to show me something wrong in this report. We just went through what's wrong with the report. I can find stuff that's good. Sure, 800,000 people got part-time jobs. Wonderful. But is that a reason to declare victory? The brutal winter weather is over? And look where the jobs are created, Ryan. So what's your take on this? I mean, you predicted that this is what they were going to do. They're going to find their one piece of data, and they'll last the rest of the year as saying, yes, look, see, everything worked. The United States is wonderful, and we can taper.
And look, and they are able to peg this whole thing like right around the 4th of July, right? Like it's like this big symbolic thing, right? Country's moving in the right direction, and we're
Happy
right
birthday,
around
America.
July. Right. Exactly. I mean, it's unbelievable to me that these people get away with saying this crap and are considered credible, right? Like the reality is they're not living in the real world. They're living in this fantasy world that the Fed has set forth, right? The Fed has created this fantasy world where it's basically they're looking for anything to hang their hat on. And essentially what you said, that reporter, voluntary, part-time, no, I don't really think it's voluntary that they want to work part-time jobs. I think it's voluntary that they might have to find 2 or 3 part-time jobs because there aren't any full-time positions for them to have, right? So I could care less about how many part-time jobs are created because really that just tells me that the economy is moving, as you say, to a part-time economy, which is not good at all. That's telling us that the economy is struggling big time. And the fact that big companies are not wanting to hire full-time workers because of healthcare costs and rising other costs. We have
and the sectors in which they're created.
Absolutely. I mean, it's a complete joke. Like, I honestly, for them to not recognize the amount of full-time jobs that disappeared, which I think is one of the biggest components to that report, right? Because we don't want to see people losing. I mean, granted, you're always going to have, probably they always say it's a good thing that the companies get rid of the bottom 20% of people, hire in new people. I understand that. But the reality is that's not really what's taking place. People, they're just having to fire people just to cut costs, whether they were a good employee or not. And
right.
I really this whole part-time thing. They want to factor out labor participation rate. I mean, like you said, it's as low as it's been in 30-some years. Where can you really extrapolate anything that is truly, truly positive? Oh, you know what is, Lewis? It's the stock market.
Oh, no, by the way, that was one of the AP points. Not only did we have a wonderful Fed, the 5th point was we have a roaring stock market. And we've talked about how ridiculous that is. We know why the stock market is roaring. You mentioned 2 weeks ago or 3 weeks ago or last week, or maybe you mentioned every time we talk, that there are these sovereign funds of governments that buy up shares in the trillions of dollars and own basically half the stock market. Add to that when companies buy back their own shares because they have excess cash and there's no great economy to invest in, they don't invest in their capital goods. They don't invest in equipment. They don't invest in hiring more people. They just buy back their own shares, reducing the float of shares. So, of course, the stock market is doing well, but not because the underlying economy is doing well or their businesses are doing that well. Revenue growth, the PEs are relatively low, Ryan, for these companies,
right.
But the price sales are ridiculously high, and that tells you one thing. Sure, they have decent earnings because they reduced the share floats down, but on a price-to-sales ratio, the reason the price-sales ratios are so high is because they don't really have that good of sales.
Right.
They're struggling, but yet they try to insist. And by the way, Ryan, even if you want to accept the broad headline number, 288,000 jobs created, that's still nothing.
Right.
It's a law of small numbers. So what? You need 400,000, 500,000 just to keep up with the population type of growth. But instead they get a net 288,000, of which 520,000 are full-time jobs lost and 800,000 plus are part-time gains. And somehow that's the second coming of the labor market and also of the entire economy. And by the way, Ryan, another thing you and I had predicted is nowhere in any of this discussion anymore is real estate.
No.
Real estate's gone. That used to be the pillar of the economic recovery. They've kind of forgotten about that. We predicted that would happen back in March, I believe.
Yeah. Because they don't have anything to show like for is great numbers for housing anymore. And it's funny you brought that up because I found an article. It was on the front page of money.cnn.com yesterday, I guess. Now it's kind of over to the side and you have to kind of search for it a little bit. But Carl Case, who's the economist who obviously is part of the co-creator of the S&P Case-Shiller Home Price Index, has came out and said the housing market is a crapshoot now. A crapshoot, okay? So if he is, and he's typically very, very upbeat about, where things are headed, right?
It's his industry, he has to be.
Right. And so for him to come out and say it's now a crapshoot tells me that he thinks that we're in for a big, big awakening here in just a little bit. Because when it's almost like, they don't want to come right out and say things that are negative, right? But they could say it's a crapshoot, and basically there's anomalies in the market. There's certain areas that are doing better than others. But he said he thinks that it's a crapshoot because people got hosed the last time. They thought that housing prices will never go down. That's just bull. You know what? That's what his comments were, because it was on to further state that the housing starts and figures have been unbelievably regular for 50-some years, oscillating between 1 million. These are the housing starts, which he considers the most
new home starts,
factor.
right? Yeah.
Right, yes. New home starts, which is supposedly the main thing that you want to focus on when you're judging a healthy economy as far as housing is concerned.
Right.
So it's typically...
Well, that's where the jobs are created in the building of new houses. Far more jobs are created there than in just flipping used houses.
Correct. So he goes on to point out that the housing starts were really regular for about 50 years, going about a million a month, annualized, right?
Annualized,
and that's in not so great times. In good times, about 2 million. So every time that it's gotten below 1 million, it's typically come back. But what we haven't had in this so-called Great Recessionary period is that in housing starts, I believe they fell back under 500,000 back in 2009. And they've been slow as crap to come back now. I think
Right, we have a chart on that on Smaulgld.com under the housing recovery and the law of small numbers, and it shows that in the last 6 years, that new housing sales are down at levels that we last saw in the 60s and 70s when the population was about 35% fewer people.
Right.
So and then what happens is when they tick up, they'll say it's the biggest increase in 6 years. Yeah, well, 6 years ago, it was horrific. It was at an all-time low.
Right.
So they try to say that everything is recovering. When you look at the last 6 years, those new home sales, as Mr. Case points out, are so low, historically low, and it makes it even more low on relative basis when they're at the same levels as you had when the country was much smaller 30 and 40 years ago.
Right. Yeah, and he goes on and calls the real estate market segmented these days, which basically he was saying that housing prices aren't guaranteed to go up across the country, which is what you and I have been talking about for months, is that really just in these major metropolitan areas are that they're really been driving these national numbers because they're so skewed. If you have a metropolitan area going up 10, 15%, but then in another area going negative or just doing nothing, it's going to pull up the overall numbers, right? But it's not taking place nationally. And he's curious to see what the demand side of the equation is going to be for millennials. Are they going to purchase homes? Are foreign buyers going to continue? Are the Chinese going to continue to pull millions and billions of dollars to buy up real estate over here?
A year ago, Ryan, we did see all those stories, and I counted them, about how millennials were going to drive the real estate market. All those articles about how to market to Gen Y, what millennials want in homes, a new, millennials in real estate, the new wave, all those types of nonsense articles about how they were all going to come storming out of their parents' basements, cash in hand, top credit, no debt, great jobs, and continue to fuel the housing recovery. Well, that hasn't proven to be the case. And now you see, and this is why it's so statistically obvious and so culturally obvious that it's not happening, that you see these big articles that somehow are insightful. When we were writing about this on Smaulgld a year and a half ago, that there's no way you can have a housing recovery without new first-time home buyers. And now they're talking about how millennials are not participating in the housing market. This is a problem. So they've got to come up with a government solution and figure out how they can, reduce their student loan debt instead of saying we should get out of the student loan market so we don't boost up the price of tuition and so that people don't have these ridiculous student loans and the student loan debt. But that's not what's happening. But again, you get this mentality that somehow they figured this all out. Well, they caused it. Now they're trying to figure out what to do about it. And when they realize what a huge problem it is, now they're just not going to talk about it anymore. Housing is not. That's not what's the big issue anymore. We got this great jobs recovery.
Right. And what's funny, Louis, is that the Fortune reporter that you had the back and forth with that's talking about all these part-time workers, that's great, regardless of whether they're part-time or not, they did that voluntarily. But can those part-time workers, can they buy homes? Are they not millennials themselves, right? Can they contribute to the housing market? Not really. Not really. And for Case to come out and say, okay, well, where is it? That basically people got hosed the last time and they're not really willing to jump back in the market even though housing prices are going up in certain areas. Well, you know what it really is probably they're in not a very stable job environment either. Right. So it's very hard to make a decision such as buying a house when you don't have a stable home front. And that's really what's taking place. We have the market data is the only good data that we have as a representation of a good economy is the stock market. Yep. But unfortunately, the fundamentals of our economy are terrible. The valuations are terrible. There's nothing to really back it up or support it other than these billion-dollar hedge funds and money coming in from overseas and companies buying back their stock to drive prices higher. This is not from your typical average everyday worker that's out there grinding away that would be putting his money in the stock market, making money back, reinvesting that. It's not happening. It's not. And I think that for anybody to really think otherwise, they're really just living in that fantasy world. Like I said, that the Fed created, right? And if you want to stay wrapped up in that fantasy world, that's fine. You and I are not in that boat, and I don't think we're ever going to be in that boat, right? Because it's counterintuitive to really think that you can look at this stuff and just extrapolate a couple good points and not look at the negative stuff. You have to.
Well, that's what I mentioned to the Fortune, but I said you have to look behind the numbers. You don't just take the headline numbers. What happened to the days of Watergate, where you had investigative reporters? Now, that guy had to risk his life, the Woodward and the other one, Bernstein. They had to really investigate potential crimes. Here all you have to do is look at reports. Right. It's not that dangerous. You look at the reports, you figure out where they've been, where they're going, and you look at the numbers, and, of course, you apply your own perception to them. But that's not what they apply. They apply a spin to them. That's ludicrous.
Yep.
There wasn't an even-handed mainstream media article that I read about the employment report that wasn't anything other than utterly glowing.
I agree with you 100%. And as we mentioned, all of the limelight has come off of housing because there's nothing at all really to take from it, except for that these anomalies that are taking place throughout the country, Washington, D.C., San Francisco, New York, are really thriving. Now,
that's where all the media companies exist, so they probably don't see it.
And you know, in all everybody, what they watch and what they read online are most of the time from these major areas, right? These are the people that are writing this stuff. But when we have Case out here saying that it's a crapshoot, he goes on to further say that, you know, if you're not buying it for the long haul, don't buy, because there's a good chance that you'll have to sit through some down cycles. Really? I mean, are you telling me something that I don't already know here? But
no, you may not, but the rest of the world is not as switched on as you or Mr. Case.
Exactly. And you know what, though? That's always been the case, Mr. Case. I mean, things can't always go up. They have to come down. I mean, that's just the nature of...
But that's how people have been taught.
Absolutely. And it's so simple. Okay, can you afford to buy a home? Are you able to? Are you willing and able to? Those two components have to be there. You have to want to and be willing to buy, and you have to be financially able to. And that's the biggest component of why things aren't moving. It's because people are not financially able to. If they were, Lewis, we would see housing starts at $2 million right now.
Right.
Because
that's what they did with the millennials. NAR kept putting out surveys, real estate groups putting out surveys, how millennials haven't lost, interest in home ownership. It's high as ever. Yeah. Okay, they're really interested in buying a home, but they can't. So what's the point of your survey?
And do you think that the builders are buying into this millennial BS?
Absolutely not. Actually, the builders are selling homes at $50,000 higher than the existing home. So the people that are buying new homes are basically a much more upscale market.
Upscale in areas where the supply is not near as heavy.
Correct.
Right? And so,
but that supply isn't limited everywhere. It's only limited in those higher end areas. It's not like in middle class and lower middle class areas they are going nuts building homes because there's a demand for them. That demand, the real demand, only exists in the upper end.
And the demand for these new homes, according to all the other reports from Fortune and all the other companies, Wall Street Journal and anybody else that's putting out these things, you would think if everything was turning the corner as they suggested, that we would have record sales, right? We'd have record existing sales. We'd have record new home sales. We would have all of these things. But we're not even remotely close to that.
No, what they focus on is that the price rose.
Right. And
on no volume. It's just like, the unemployment rate goes down because there's no one in the labor force. And when you have initial jobless claims down, there's fewer people left to fire. So you have a lower initial jobless claims. It's the same thing with housing. If housing prices go up on a small number of sales, they don't care. They don't point out, well, no one really bought many houses. The sales are at 30-year lows. The prices went up, so there's a recovery. Same with the initial jobless claims. They went down. It must mean the labor market's improving. Again, they don't look behind the numbers because they don't want to see what's there.
Well, you're right.
Which is no recovery.
How many times do we see them focus on unemployment benefits? How many people are on those? And how many people are on food stamps at this point, right? They wouldn't put that. They don't want to put that information out there. Because
when they do put it out, when they say unemployment benefits, they recently touted it, Ryan, but here's why they touted it. Unemployment benefits, people on them declined. Well, that's because so many people were on long-term unemployment for so many years that they're now coming off of those.
Right.
So now fewer people are on them because they fired everybody over the last 5 years. There's fewer people left to fire to get on the benefits. They already loaded them all up. There's so many people on them. And now people are coming off of them, not because they're getting jobs, because their employment benefits have run out. So they're touting that number as wonderful. Fewer people are getting them and fewer people are applying for them because, more people have been unemployed for so long that they cannot qualify for them anymore.
Right, they've worn out.
But that's not how they tell the story. They tell it as if it's some wonderful thing, improvement in the economy.
Yeah, and I understand the need to spend things, and I'm okay if you actually have something legitimate there to back some stuff up. I'm okay with that. Like, you know what? I understand you want to make a headline one way to get somebody to open it and read your story, but at least make your story, have some sense to it. I mean, you know what I mean?
No. You know what it is, Brian? They don't. It's not even that. They have a mission. They have instructions. They have to put out propaganda that fits the narrative that everything is fine. In fact, that is fine on the up and up.
Yeah, well, that's also why. Remember, I always come back to that. You know, how long can this go on, and how long can we keep a low interest rate environment? Well, I guess as long as the media continues to peddle this, and as long as the Fed sticks to their narrative, and as long as the president is there, it'll go on until Obama is getting ready to come out of office and Hillary goes in.
But remember, look at the comments under all these stories. 90% of them are basically saying, "Are you kidding me?"
Well, but you know the other thing about these
Which
stories,
means you're not fooling anybody.
Right. But you know the other thing that I always watch with these comments, like they'll be talking about a story about, housing, right? And then all of a sudden in the comments, you have people arguing over teachers should get paid more and firefighters should get paid less. I mean, things that are not relevant to the article at all, right? But it all is coming back to, like, people are upset that they're not making enough money, that they don't have jobs, right? That is very consistent in all the comments for all of these articles. People are turning to the media for answers. Unfortunately, it's the wrong place to turn, right? And creates these like little mini online fights back and forth, or whatever you want to call it. This banters back and forth underneath these articles, but all of them go back to the same thing. They're mad about they're not keeping enough of their money, and they don't have jobs, or they have part-time jobs. They're not getting paid enough. It's always the same thing. And in a recovering economy, Lewis, we wouldn't have all this bickering. We would have people happy. They would be buying jobs.
Oh, you'd be exchanging stock tips. See, that's the other thing. You don't have that. Remember in the internet bubble, you had people, everybody was a stock expert in the mid-2000s. Everyone was flipping homes. You don't have that widespread mania in the stock market where people are all stock gurus and they're buying stocks. As we mentioned, the stocks aren't being bought by everyday people. That's probably a good thing, but they're being bought by Wall Street, hedge funds, sovereign governments, and homes. The only people buying and flipping homes are investors. You don't have regular people doing that. That's not a good thing either when you have half the population flipping homes and buying shares on margin. But the point is, this type of recovery is so thin. The other is fake. Don't get me wrong. When you have everyday people in a mania, that's not good. But this is a mania that only the wealthy are participating in.
Oh,
and the difference is when it crashes, they're not going to get hurt.
Well, and
they're just going to take the chips off the table.
When you have a low interest rate environment like we've had for such an extended period of time right now, if the economy was really turning the corner, then interest rates would naturally rise, because it wouldn't matter if we had a 1% increase in interest rates. There would still be the demand for people to obtain home loans, because anything below 6% to me is still a steal, right? But if they can't get things moving at 4%, they're not going to get things moving at 5%, they're not going to get things moving at even 3%. Because guess what? If the underlying fundamentals of the economy are not there to support it, even with a low interest rate environment, we can't get things moving. And I think that tells you all you really need to know. If you're not buying homes at 3%, 4%, 5%, then you're not going to buy homes, and it's because there's a bigger issue at hand. And that's the issue that the Fed cannot fix. They can't. They can dump all the liquidity they want into the market. They can keep interest rates low. They want to do all these things, but it's not fixing the underlying problems, and it's going to stay that way. That's why these are going to become the lost years, really, Lewis. You know what I mean?
Oh, they already are. This is what happened to Japan, and they've not come out of it. All they've managed to do in Japan after 20 years is finally create some type of false inflation price inflation by printing trillions and zillions of yen. That hasn't done any good. It just makes a miserable situation worse, because now prices are more expensive for the average Japanese person, but they're not making any more money.
Right.
The same here. They keep touting we need more inflation, but if wages don't go higher prices aren't going to make people's wages go higher. It's just going to make things more expensive, and we talk about it. Energy, food, housing, health insurance, all those prices are up in the high single digits to double digits.
Right.
But wages aren't higher, and they view that as a good thing. Or they'll say, well, don't count food and energy because they're volatile. They always change. Yeah, but they've been always changing. They've been going up every year and every month.
Yep. Well, I always find it interesting to read articles like, on Zero Hedge, but the one I was reading the other day, I'm going to pull it up here. This is the worst of all possible worlds. The Fed is borrowing returns from the future. And it was actually an article that was on Zero Hedge. And they basically interviewed three legendary investors, Felix Zulauf, James Montier, and David Ivan, basically on their shares in the financial markets. And I thought that this is actually very interesting to get their take on it. These are obviously billionaires. And they asked some interesting questions about the Fed. But I thought that one of the most interesting parts of it, they asked Felix Zulauf basically about the whole Federal Reserve and the butterfly effect that took place and the tapering. Is it really a problem? And he goes on to talk about the Fed, and he says that we will continue to swim in a sea of liquidity. The question is whether there might be other events and developments that may not be camouflaged by liquidity, which could cause a change of investor expectation. Liquidity is one thing, but there are fundamentals too, also, which is what you and I argue, Lewis, right? They go in to say, these three guys, that they think that the one, they all kind of agree that China is the one really unknown. They basically have more credit created in the last 5 or 6 years than the total loans outstanding by the U.S. banking system.
Wonderful.
And I mean, that can't be a good thing, right?
Yeah.
And it says that there was evidence that tells us the Chinese investment and construction boom has not broken yet, but it's cooled off. And they're wondering what's going to take place there. At some point, they feel like that the currency could really lose some value, which would actually put some deflationary pressures on us here in the United States. So they're all kind of concerned that there could be outside factors, which was what you and I had mentioned a while ago, Lewis, that there could be these outside forces, right, that really cause us to have to pay more attention to what's taking place. They asked them about whether the other central banks are going to tighten, and they pretty much all said they don't really see any monetary tightening taking place by other central banks, right?
If anything, they're going to loosen, and Europe will do QE.
Right. And they've already, we've already had these other entities buying up what we're basically not buying anymore, right? Because we have to be able to continue this. I mean, if we stop altogether, we'd have interest rates rise to the roof, which they're not going to let happen. It's just not going to happen.
Who's going to buy the bonds, Ryan?
They're buying
60. The Fed is buying 60 to 90% of the newly issued bonds, or supposedly, has stopped doing that. But yet the demand has remained strong, and the interest rates may remain low. Who's buying the shares? At some point, don't they just either become the market and destroy all price discovery, and then the government just buy everything? That's where it seems to be heading.
And, on your blog, you talk a lot about gold and the manipulation of gold and silver prices. And, they had asked these same billionaires the still things, do they like scarce assets? Are they still undervalued? And, they kind of feel like, yeah, gold is still a smart play. I mean, obviously it's a scarce asset. And, they actually felt like holding some stuff in gold and silver, and also having some cash on the sideline to be able to buy back in the stock market when it kind of crashes, right, is a good thing. And these are very intelligent guys here, Lewis. Like, they're basically telling you that they're not really confident in anything about this economy. They're saying that the underlying fundamentals aren't there.
But they play along with it, which is what many people should have done, because, you've made a lot of money in the last 2 or 3 years just following along with the Fed. You can believe that, these companies that have no earnings, but when you see a company like Zillow go from $20 to $130 on no earnings, they're in a market or industry like real estate, which is basically got flat sales, and yet they're taking off because they might make money one day in the future. There's so many examples of those types of stocks, and you make real money in those types of stocks. You don't make money in the companies that are, because those companies are struggling. See, companies that are in the social media space, they're struggling, but they're not struggling financially because they took in hundreds of millions of dollars of IPO money, so they're not going to run out of operating money. So even though they're not making any money, They can tout all the wonderful, innovative things that they're doing, and people buy into that because it's speculative. Price goes up, and they make money, and they're proven to be geniuses. And the price, just like in the, if you remember this NASDAQ bubble, those prices, you could have made money. It wasn't like the bubble was only around for 8 months to a year. You could have been buying internet stocks from 95 for 5 years. Right. You could have bought AOL, Netscape, Sun Microsystems, all those stocks, and held them from $2 a share up to $300.
Right.
Eventually they crashed, but the point was, it wasn't like they went straight up, in 3 months, 4 months, and then crashed. They just kept going up for years.
Yep.
That's what we're seeing now.
Well, and these financial gurus and billionaires, they also have the luxury of having enough capital that they can play all sides of the equation, which is what they're talking about in this article. They can keep cash, they can buy some gold and silver, they can short certain things, they can buy Russian equities, they can buy so much stuff. That
right, and some people can't even buy silver because they don't have enough money to buy food.
Right.
So when you say, you should just go and get yourself a couple of silver coins, it's like, well, what money? I said, well, they're only $20 each. Like, I don't have $20.
Right, I got to cash that in for my gas.
Exactly.
Yeah.
That's what they don't realize is how many people are in that circumstance where they're not working or they're underemployed.
Right. Yeah. Well, and
they talk about roaring stock market. No, it doesn't mean much to people.
Right. Well, and they also talk about when you are talking about equities, right? And are we at the end of the run here? Is this the end of the bubble? And they kind of go in here to talk about that generally the retail public is the last person to jump into a market, right?
Right.
But right now, nobody really has the capital. The average retail investor out there doesn't have the capital to really get in it.
It's not the same as I mentioned as it was back during the internet boom.
Yeah, maybe the institutions could jump back in, but the retail investor just can't do it because they don't have the means to do it right now.
Right.
So,
same with housing. They really don't have the means to be snapping up these houses, irrespective of how low rates are.
Right. So for many people to think that we're still going to have, one last bang with the stock market and it's still got some room, well, the only way that it can continue to be fueled is for these hedge funds and for companies to continue to buy back their stocks. But at some point, if the
economy somehow turns around and these companies can grow into their valuations, which I don't see happening.
No. Well, once we get the second quarter data, remember how we went over it the last time with all the major stores? We're going to do the same thing this time, and I can't wait to see the way somebody spends it. So if we don't have those numbers positive, then, which we know is not going to happen, right, Lewis? They're not going to all of a sudden go from first quarter negative $300 million to probably second quarter up $50 to $100 million. Chances of that happening are probably slim to none. But they'll spin it as in they're moving in the right direction, just like they can spin everything else. So, what does the guy out there right now that's looking at all this, what does he say? So does he say, well, so basically all you guys are telling me is that the economy is not on a strong foundation right now. They're even though we have a low interest rate environment, and although we have a relatively high stock market right where we're at, what do I do? Well, the reality is that there's not really much you can do. You can only do
if you have money, there's plenty you can do.
Right, but the average person doesn't. You know what I mean? The average person
You have
doesn't.
options. I mean, ridiculous number of options. If you have a lot of money, you could be hedging, you could be buying stuff, you can be selling stuff. But if you have no money, there's not much you can do.
Right. I mean, the average probably person is negative every month, right?
And has $12,000, $15,000 in credit card debt.
Right. So
why don't they go out and start a hedge fund?
Well, you just their options are somewhat limited, and they're the same people that are looking for multiple part-time jobs, right? They are looking for anything to potentially get ahead, but I mean,
you know how hard that is, Ryan? I've tried that because it's very hard to schedule your part-time jobs. When you have a part-time job, sometimes you have Monday, Wednesday, and Friday, right, and then they flip you the next week to Tuesdays and Thursdays. Okay, you go to a new employer, and they need you Tuesdays and Thursdays. You can say, I can only do that every other week, and so that doesn't work for me.
Yeah, exactly. That's what I mean. You go from one place to the next, and then they find out that you're not really flexible. You're the first person that they're going to get rid of.
Right, because the reason they want part-time workers is they want them to be flexible.
Yeah, they want a part-time worker that only has one part-time job. right?
Of course.
The only way you can really get around that is if you're working days and nights.
Yeah.
I mean, if you're working days and nights, then yeah, you can be somewhat flexible, but that's not really realistic, especially for people that have kids. Yeah, so I mean, I think that
there's only 24 hours in the day, Ryan. I mean, you know.
that is true. I mean, there's many people that are able to balance these things, but the reality is
you know what, Ryan? Sometimes it's a lot easier just to go on the relief.
And that's what many people choose to do.
Yep.
Right? Because
now you're a voter.
Right.
Now you can vote yourself a raise, and you can complain to politicians that they haven't fixed the economy, and they say, don't worry about it, we'll extend your benefits.
Yeah, I mean, this economy is so manipulated that I don't. There's no way that these numbers can get better. Let's just put it that way, because it's so far gone. They'll spin it as if it's getting better, but it's not. It can't.
They even said, Ryan, they've been talking about how that we have to just live with it like this, which basically means from now on there's not going to be growth, and the only way you're going to get growth is by looking up longingly to the central banks to throw you a bone that they may throw a little stimulus or keep interest rates low. They're basically saying, you know, they've never said, well, we'll remove all this apparatus of central bank planning and see what happens. No, they say that's a recipe for disaster. We tried that in the 1800s. You know, some kind of ridiculous argument that free markets don't work, that we need to be here. But yet they're saying things don't work, but they'd be worse if we weren't here. And therefore, we've got to stay at the wheel firmly in command, and we've got to control even more of the economy.
Well, and I mean, who loves that mentality? The big banks, the hedge funds, everybody else, they're the ones. That's
guaranteed employment, guaranteed money, guaranteed riches. That all the money that ever gets created, they're going to have a piece of. It's going to flow in their direction.
And you can be guaranteed to make malinvestments and be bailed out on the other side with no recourse, right?
Or make malinvestments, and if they work out because there's a speculative component that the Fed has pushed, you'll make the money.
Well, you know, what's funny is, like, yeah, a lot of the times when their malinvestment ends up working out, like you suggest, there's such an upheaval amongst other people that they then turn around and the regulators get involved, and all of a sudden they fine them. It takes just some of their money away, right? Just to say that they're doing their job, like then they're not just completely one-sided. Right. Big deal. He made $10 billion. You took $1 billion from him. You think he really cares? You know, it's
and all it does is it gives those agencies that place the fine more money to hire more people, basically to not regulate. Right. And then those people, because they were involved in a high-profile case involving a fine, can then go work at one of the other banks, you know, because they now know something about how to prevent the bank that they're going to from getting in the same trouble, and then get paid millions of dollars. Yeah, and nothing of any value or benefit to the economy or to the society has been created. You know, when you create problems like, well, we have all these regulations that you have to follow, yeah, you create jobs, but they're only jobs that exist not because of any need or desire, but because they've created a need, not the desire, to have these regulations and have somebody interpret them.
Right. You know, actually, the other day I was talking to a loan officer from a bank and just having a conversation with him about, you know, how everything's going. Basically said it's crappy. He's having a little bit of influx right now into the summer. But he was telling me a story about, like, the regulations are so bad, obviously, in the mortgage industry right now, just as far as, like, compliance, as far as, like, when you're taking a loan application, you're pre-qualifying somebody, the timeliness of sending out certain disclosures get sent out if you're, you know, pre-approving somebody versus once you actually find a property, there's a separate document that they don't go out in a timely manner, then that application actually can get denied, not denied based on the merits of the borrower, but denied because the loan officer didn't follow the compliance rules set forth, right? So technically somebody could get denied for a loan, Lewis, when it has nothing to do with them.
Right. It has the same, you know, the SEC has the same thing. If you don't have to commit fraud to get in trouble with the SEC. You just have to not include a section that they ask you to include in their prospectus, and if it's not in there or if it's slightly off, the investors can sue even if the reason they might have lost money had nothing to do with that particular sentence being off or not in the prospectus.
Right.
No, that's crazy because that means it wasn't important. It's not why they lost money. Yet they want to ensure compliance with these rules. Now you have to hire more lawyers, and now somebody's going to get money from the company because they failed to put a sentence in, or the sentence was slightly off, even though it was immaterial to the reason why the investor might have lost their money. And that's what it's coming. People they mock people and they say, oh, all you have to do is lower taxes and get rid of regulations. That's kind of true. If people understood what the regulations, many of these regulations are. People think that all regulations are like good and they're protecting the public. Most of them aren't. They're just wasting the public's money, and they're not protecting the public at all.
Right. I mean, how many disclosures, especially like in the mortgage business, have they created to really help the public? They're more confusing to the public than anything else. If you just a truth in lending statement that has an APR calculation on it, 99% of the people that have ever looked at that document have no clue what APR means, and actually they get scared after they.
And half the lawyers probably couldn't understand it on the first read either.
Right, and it's a joke because ultimately you want people making good decisions and buy properties when the interest rates are low, and then you give them confusing documents, and then you descript the process. I mean, the fact that you could potentially be denied for a loan and it has nothing to do with you is crazy to me, right? Because they essentially would have to deny that loan, and you'd have to go to a different bank and go apply for another that same loan you were applying for from that bank, even though they don't necessarily have to tell you that they made an error in compliance, just basically that you were denied based upon disclosures not getting sent out in a timely manner. I mean, or you checked the wrong box. So it's difficult enough to get a home loan. And then you add in the compliance and the regulation, you're making it even more difficult. Is it any wonder that the mortgages are down to the numbers they are right now?
And part of that is from the regulatory perspective. The larger part is because of the economy.
Correct. Which is why we're starting.
But you don't need that added drag where somebody actually would be able to get a mortgage, but they've got regulatory issues.
Oh, absolutely. I mean, that's and that's why Dodd-Frank and all these other things. I'm starting to see that people don't really care, and now they're turning and everybody's turning on the CFPB, saying that they're just rogue agency. Well, they were all along. That's what they were set up to do, is to take money.
Right.
And so now when all the mortgage industry is hurting and basically mortgage companies are going to go out of business and they're not going to be able to get, in tax revenue and anything else from these companies, now they're like, oh, well, the CFPB is bad, right? Now they're going to start pulling them back some. So it's just, it's an up and down thing. They can't, they're stuck. There's nothing you can do because, like I said, you can't fix these underlying fundamentals. The Fed can't. And the more difficult you make it, the worse off the economy is going to be. I wish that we had positive economic indicators, Louis. I really wish, because that would allow us to actually talk positively about what's going on. You know what I mean? Unfortunately, we have to look behind the reports. We have to, try to.
It's not even unfortunate. That's natural. That's what you should do.
Well, I'm saying it's unfortunate because I wish the economy was actually doing well, right? Like, these are things I wish.
Even if you look behind the numbers, the headline numbers.
Right. I wish that there was some positive stuff that we could extrapolate out. I mean, and, like I said, we talk, there's anomalies everywhere. So in the Northern Virginia area where I'm at right now, it's doing much, much better than the rest of the country. Why? Jobs. We've got, military bases all over the place, government contractors. There's so many more opportunities here than the rest of the country. But the reality is that even here, there's people that are struggling. There's people that are lining up, for unemployment benefits. So
take the government jobs away from the equation and the ancillary government jobs, then your area is no different than anywhere else.
Correct.
The Washington, D.C. area. Yeah.
It just happens to be a region that benefits from all the government opportunities, right? I mean, but, the private sector is now, we're not seeing these huge increases in companies formed, are we? Well, no, of course not, because guess what? These companies don't have access to capital.
Unless they're servicing government workers. Like, you have restaurant business, things like that. That's private sector, but they benefit from having full employment in the government sector at relatively high wages. And then people say, well, why don't we just replicate it? Well, everybody should work for the government. Who's going to pay the taxes to put those people to work?
Right. Well,
but everyone should just get a job at the post office at $150,000 a year. Even better, what about the people who say people should have guaranteed income?
Right. Well, it's what these people have been conditioned to think, right? Oh, you
I don't understand where money comes
never
from.
Lose your job. Right.
They now believe money comes from the government, and the government can create money, so why don't they? And they do now.
Right.
And then they say, and look, it works. See? We're getting all these jobs.
Yeah, the government's doing what they're supposed to be doing. Look, we have a job.
You know, when the media goes out of business, like the newspapers or the colleges, they'll just prop them up too.
Yep.
Print money and give it to the colleges, and we can't have them not raise tuition 15% a year.
Right.
Forever. They got to continue to do that.
Yeah,
they'll either print money and bail them out, or they'll guarantee more loans so people can go.
Yeah, I mean, and that's the only way that this can continue to go on, is to continue to bail out, to continue to lend student loans, and then turn around on the flip side of that, Lewis, and then defer those student loans out further, or if they paid them for a certain amount of time, to not hold them fully responsible so they don't have to pay them all the way off, right? I mean,
well, then again, that's the same thing as the government paying for it.
Right. They'll make up rules, and the taxpayers are paying for all of this.
But the college still got their money.
They sure did. And they also probably are going to kick back millions and millions to the next presidential candidate, right?
I think what people need to do is and employers is start to rethink, do you really need to go to college and pay all that money? Because they continually put out there, Ryan, these surveys. The Fed puts them out. I don't know why the Fed puts out a survey on the value of a college education. Well, I know why. Because they're part of the scheme. But they continue. Hillary Clinton's out there. Everybody should go to college. Oh, it's the land of opportunity. Obama says it. They all say it. That somehow your success is on the basis of sitting through 4 years of classes in between drinking bouts.
Right. Well, just think. Hillary went to college, and then she came out of the White House broke, right? I mean, so it obviously did her some good.
Yeah.
Yeah, I mean, I agree. I agree with you 100%. I mean, there's the access to information and everything. College is not a necessity. People yell at me all the time for saying that, but I could care less.
You've got kids, Are you putting away money? They must go to college, otherwise their lives are going to be ruined? No. Because if you teach your kids the right thing and you teach them what's taking place, I mean, there's so much you can educate with the amount of access to information and books and everything else that we have very easily these days. It's not rocket science. People feel like by just going to an you can learn rocket
college,
science without even going to college.
You can learn a language in a month, but just going online. I mean,
but sitting in the classroom with 48 or 120 kids, and the teacher say, "Repeat after me, pues entonces."
Correct.
Now you know Spanish.
Do you think it's necessary to sit in the classroom for 7-8 hours a day, Louis? I don't. I
you
really
ever see kids in classrooms? Just take a video. Half of them are asleep.
Because you know what? It's proven that even when people go into the workforce, actually, they did a study one time on CEOs and the amount of time that they actually have focused energy where they're getting something productive done each day. It's 10 to 15 minutes each day, Louis.
Yep.
10 to 15 minutes. So just imagine, and the average person, really, your attention can't really last more than about a 90-minute cycle. So.
And you learn more from reading than you do from listening. You absorb far more in a shorter period of time.
And if you were able to read and read and write about things that you were actually interested in instead of the things that somebody else wants you to be interested in.
Oh, a lot of it's propaganda, too, because look at when they teach you economics. Their job is at stake, so they're going to teach you government spending is wonderful because it pays their salary.
That is very true. I remember my economics classes to this day, and it's just interesting now how I see things from a completely different perspective than when I was in college. I'm kind of glad that I slept through many of those classes. But
aggregate demand, and
Right. We're coming up on the end of the show, Louis. I want to thank you again for coming on. If you wouldn't mind, give our listeners your blog so they can check out your blog post this week.
Sure. It's Smaulgld.com. I have a blog post up there, or 2 or 3, every week. The most recent one is on gold and silver price manipulation, all the suspected cases and what's happened with those. And later on this week or next week, I will have another post on gold and silver manipulation, but this time giving actual and concrete examples of admitted manipulation of the gold and silver market. So please check it out at Smaulgld.com.
Awesome. Thanks, Louis.
Thanks, Ryan.
Thank you guys for tuning in. Please download, subscribe to the show on iTunes. Also, you can stream it live at realestate360live.com on iTunes. Just search Real Estate 360. If you have any questions, go to realestate360live.com. On the right-hand side, there's an Ask a Question button. Just click on that, and we will be glad to cover any questions you have on future episodes. Until next time.